Hi everyone, I'm Caro. Today let's talk about index funds and ETF investing. A lot of people see Warren Buffett's advice, regularly investing in index funds, as a guaranteed path to financial freedom. They think as long as they stick with it blindly, they'll sleep well at night. But that mindset makes investing sound way too simple. And that kind of oversimplified thinking could leave you with zero returns in the future, or even a loss. Why do I say that? Because when people treat Buffett's words like absolute truth, almost everyone forgets that his advice only works under three crucial conditions. Three assumptions that are rarely discussed in depth. In today's video, we're going to break down these three foundations, clearly and systematically. If you don't understand them, then your so-called dollar-cost averaging might actually just be a gamble with poor odds. The myth of dollar-cost averaging started with Buffett's famous 10-year bet. In 2008, Buffett publicly challenged the top hedge fund managers on Wall Street. He said, "Let's see if a low-cost the Standard & Poor's 500 index fund can outperform your hand-picked actively managed funds over the next decade." Buffett made that bold challenge based on two key ideas. First, the Standard & Poor's 500 index ETF represents the overall market benchmark, and it's extremely hard for active investors to beat the market consistently. Second, hedge funds charge high management fees and performance fees, which eat deeply into investors' actual returns. And the result? The index fund crushed them, with an 8.5% annualized return versus just 2.2% for the actively managed funds. That single bet made the strategy of investing in index funds legendary, and it kicked off a global ETF boom. But here's the problem. Can this seemingly perfect textbook answer really be copied and applied anywhere, without conditions? Probably not. Because what most people overlook are the hidden, essential factors behind its success. The first, and easiest to overlook, is location. Remember this. Buffett never said the act of buying index funds itself was the magic. What he believed in was the long-term strength of the U.S. economy, represented by the Standard & Poor's 500 index. His success story is deeply rooted in American soil. You can't just casually apply that to every other country's stock market. By the way, there's another Buffett quote that's often taken out of context. In one of his shareholder letters, he wrote, "Over the past 240 years, betting against America has been a terrible mistake, and it still is." That was a statement based purely on historical investment data. But later, some people twisted it to mean, never short your own country, which is absolutely not what Buffett meant. So why do I say that? Because here's a simple truth. Not every country's stock market rises steadily over time like the US market. Let's take Japan as an example. When people mention Japan, we often hear about the lost 2 decades, or even lost 30 years. In the stock market, that shows up in the Nikkei 225 index, which peaked at around 39,000 points at the end of 1989. After that, the bubble burst, and Japan's economy fell into decades of stagnation. Even now, 35 years later, the Nikkei is still below 46,000 points. If a Japanese investor had followed the advice of some Japanese Buffett back then, faithfully investing every month into a Japanese stock market ETF, they'd realize that after 30 years of discipline, their returns are painfully disappointing. So then, what's the point of that kind of investing? Let's look at another example, China's A-share market. Many veteran investors still remember the massive bull run back in 2007, when the Shanghai Composite Index surged to a historic peak of 6,124 points. At that time, almost everyone believed that a golden decade was coming. But what happened? More than 10 years later, the Shanghai Composite is still hovering around the 3,000-point range, going up and down like doing push-ups. Over the past decade, if you started your regular investments right at the top of that bull market, chances are your account would still be in the red today. Chinese investors often joke, 10 years of trading stocks, and I end up with nothing. It sounds like a joke, but it reflects a brutal reality. In a market that stays flat for years, with short bull runs and long bear cycles, time doesn't necessarily become your friend. It can actually turn into an enemy that slowly eats away at your capital and patience. Japan and China are just examples of markets that went nowhere for decades. But in human history, there have been even more extreme cases. Some stock markets literally disappeared overnight, wiping out every investor's wealth. Yes, you heard that right. Gone to zero. For instance, in 1917, when the October Revolution broke out, Tsarist Russia collapsed. The once thriving St. Petersburg Stock Exchange was immediately shut down by the new government, and every stock became worthless overnight. Or take pre-1949 Shanghai. Back then, it was the financial center of the Far East, full of trading and excitement. But after the founding of the People's Republic of China, the old market vanished. Even though the Shanghai Stock Exchange reopened decades later, it was a completely new market. The original investors' wealth had long turned to dust. The same thing happened in Germany during World War II. When Nazi Germany fell, its entire economic and monetary system collapsed, and naturally, so did its stock market. Now, I'm not trying to scare you with these extreme examples. I'm just trying to make one simple point. Your investment is built on the stability and long-term growth of your country. Buffett's advice works in America because he's betting on the US itself, a country that, over the past century, has had unmatched military power, the strongest currency, world-leading technology, and a mature legal and financial system. That's why we have to be very clear. Blindly copying a regular investing strategy from a powerful, ever-growing economy like the United States into a market that's stagnant or full of uncertainty will only lead to disappointment. When you bet on a nation's future, the first rule is, choose the right nation. That's the first and most important premise. Okay, let's say you picked the right country, for example, the United States. Does that mean you can just close your eyes and invest in any index fund? Of course not. This brings us to the second key premise, choosing the right index. Remember this. Buffett believed in the Standard & Poor's 500, also known as the Standard & Poor's 500 Index. That doesn't mean every index fund, especially those fancy thematic or narrow sector ETFs, is worth holding long-term. There's a world of difference between them. So why is the Standard & Poor's 500 so powerful? Its biggest advantage lies in being a broad-based index, and one with strong adaptability. Broad-based means it covers a wide range of industries. It includes 500 of the most representative publicly traded companies in the US, spanning information technology, healthcare, finance, and consumer sectors. It's like having a well-balanced meal instead of eating just one dish. This diversification spreads out risk and prevents you from losing everything if one industry declines. Even more importantly, it has self-renewal ability. The Standard & Poor's 500 isn't a fixed list. It constantly updates itself, removing companies that are losing competitiveness and adding new ones that represent the future of the economy. For example, Kodak, once a giant in photography, was dropped from the index when the digital era arrived. Meanwhile, companies like Tesla and Nvidia, representing the new economy, were later added in as they grew stronger. This mechanism is crucial. It ensures that the Standard & Poor's 500, also known as the Standard & Poor's 500 Index, always represents the most dynamic part of the American economy. When you buy it, it's like owning an automatically self-updating portfolio that keeps the winners and weeds out the losers for you. You don't have to study which companies will rise or fall. The index does that hard work for you. That's the real secret behind why the Standard & Poor's 500 can keep growing over the long run. Now that we understand its advantage, let's turn back and look at those so-called narrow-based indexes or thematic funds. What's wrong with them? Well, narrow-based means exactly what it sounds like. Their investment scope is extremely limited. They usually place heavy bets on a single industry or a trendy concept. And these funds have two fatal flaws. The first problem is their timing. Have you noticed a pattern? These thematic funds always seem to be launched at the very peak of an industry's hype cycle, when valuations are sky high and everyone is losing their minds with excitement. Why? Because that's when they're easiest to sell. When the story sounds amazing, that's when retail investors rush in. So from the moment these funds are born, they're almost designed for you to buy high and hold the bag. You're not really buying future potential. You're buying an already overhyped dream. The second problem is risk concentration. We all know the saying, don't put all your eggs in one basket. Well, a narrow-based index is that one basket. If that sector's cycle reverses, or the concept turns out to be a fraud, you'll be staring at massive, unrecoverable losses. The most typical example? Between 2020 and 2021, during China's big bull market, tons of new energy-themed funds were launched. The hotter they were back then, the harder they crashed in the following bear market. Many of those funds lost half their value. Some dropped by 70 or even 80%. Far worse than broad-based indexes like the CSI 300. Your so-called regular investment turned into a long, painful process of averaging down. The more you invested, the flatter your returns, the deeper your losses. So you see, even though both are index funds, broad-based and narrow-based are completely different species. One is a steady ocean liner, the other a fast but fragile speedboat. Buffett wants you on the first one. Now, this discussion about what to invest in, that's only half the story. We also need to go deeper to talk about the ethics of index construction. Have you ever wondered who decides which companies go into an index and how much weight each one gets? Take Standard & Poor's, for example. It's an independent third-party rating agency with more than 100 years of history and an outstanding global reputation. Its index construction rules are completely open, transparent, and objective, and its core business is maintaining credibility. They've turned the act of building indexes into a respectable business itself. When you invest in their index, you can trust they won't bend the rules for profit. But not every index provider in the market is as disciplined as Standard & Poor's. You might think an index company doing something shady sounds like a conspiracy theory, but real life can be stranger than fiction. Let me walk you through a real case, a classic one. The main character is a Hong Kong-listed company called Yaojie Ankang. Here's how the story goes. In June 2025, this company went public in Hong Kong. There was nothing particularly special about it, just another biotech firm that hadn't turned a profit yet. But here's the key. When it first went public, the number of shares actually available for trading was very small. Its market value was only about 200 million Hong Kong dollars. That meant a few savvy players, let's just call them market manipulators, only needed around 300 million Hong Kong dollars to buy up most of the freely tradable shares and gain tight control of the stock. And then, the show began. The first move was to release a piece of positive news. By early September, the company was suddenly added to several Hang Seng series indexes, like the Hang Seng Healthcare Index. Many investors saw that and thought, wow, this stock just got included in an index. That's a great sign. And since ETFs tracking those indexes had to buy it, the stock price immediately jumped 20% that same day. But here's where the trick lies. The Hang Seng Index series calculates weights based on free float market capitalization. Because Yaojie Ankang's tradable shares are so limited, even though it was included in the index, all the ETFs tracking it combined only needed to buy around 5 million RMB worth of shares. That's basically pocket change for a company worth several billion. It's like throwing a cup of water on a wildfire. It can't possibly move the price much. So this was more like a carefully staged trailer, meant to grab attention from the market. The real killer move came right after. Here's the real headline. A mainland index company called China Securities Index Cumber Limited, CSI, runs another index known as the CSI Hong Kong Connect Innovative Drug Index, and they also added Yaojie Ankang to it. Now here's the scary part. The whole thing was done almost in secret. You couldn't find any announcement about it on the company's website. There was no updated list of index constituents either, which means, as an ordinary investor, you had no idea that the ETF you owned, the one tracking that index, had already gone through a massive change in its investment scope. So how was this discovered? Only a handful of the most experienced ETF professionals noticed it. They carefully compared the daily ETF creation and redemption lists, which are extremely technical internal documents, and from tiny differences, they spotted it. On September 12th, Yaojie Ankang wasn't there, but by September 15th, it suddenly appeared. So what's the real difference between this inclusion and the earlier one in the Hang Seng Index series? It's all about weighting. By reverse engineering the subscription data, analysts found that the CSI index gave Yao Jiankang a weight as high as 2.62%. And what does that mean? It means that all the mainland ETFs tracking this CSI Innovative Drug Index were forced to buy 944 million RMB worth of Yao Jiankang shares immediately on September 15th, regardless of the price. Now you can see how terrifying this setup really was. Let's break it down. These experts spent 300 million RMB upfront to lock up most of the tradable shares. Then, using a non-transparent index rule change, something ordinary investors could never know about, they created out of thin air a rigid buy order worth over 1 billion Hong Kong dollars, all scheduled to hit on one single day. And that buy order? That's the money of everyday investors, people like you and me who bought those ETFs. So on September 15th, we witnessed what could only be described as a historic spectacle in the stock market. On top of its already massive rally, Yao Jiankang's stock soared another 124% in a single day, shooting up from a bit over 10 Hong Kong dollars to more than 400. Picture that scene. On one side, countless ETF funds were buying like robots, taking orders, chasing the price higher, without a second thought. On the other side, the insiders who had positioned early sat back calmly, smiling, selling off their 300 million cost shares to these ETFs at 10 times or even higher prices. The investors' money quietly flowed into the insiders' accounts under the cover of opaque index rules. And once those insiders finished cashing out, what was left behind? A pile of losses and a stock price in free fall. This real, and somewhat brutal, story exposes the darker side of how some indices are structured. But what you might not know is that some of the world's top investors have even more radical views. They believe that cases like Yao Jiankang are not isolated accidents, but rather inevitable consequences, symptoms of a structural disease born within the passive investing ecosystem itself. One of the sharpest voices is Terry Smith, often called the Warren Buffett of Britain. His view might completely shake up how you think about ETFs. First, Terry Smith compares passive investing to Marxism in the capital markets, a bold but spot-on analogy. He says that capitalism's core strength lies in efficient capital allocation. Smart investors study and analyze companies, then allocate money to the most productive and innovative ones, driving real progress in the economy. But what does passive investing do? It gives up thinking altogether. It just blindly allocates money based on market cap. The bigger the company, the more money it gets, regardless of whether it's an industry disruptor or a dying giant, whether it's overvalued or undervalued. This size-based allocation, in his eyes, is a distorted form of planned economy. It rewards mediocrity, punishes innovation, and ultimately undermines market efficiency. Secondly, he argues that passive investors are free riders in the market. What does that mean? Who actually discovers a stock's fair price? It's the active investors, the ones who analyze financial reports, study industries, and trade based on research. Their hard work keeps prices aligned with true value. Passive investors, on the other hand, don't take part in that process at all. They simply accept whatever price the market gives them and hop on the train driven by active investors, without paying for any of the research or effort that makes that train move. Terry Smith warns that as more people hop on for a free ride, and fewer people actually drive the train, eventually it'll lose direction. Prices will drift far away from real value, and the entire market will stop functioning efficiently. What's really scary is that he believes the ETF structure itself hides systemic risks. It's like a potential cancer growing inside the market. Many ETFs are built on illiquid assets, like small cap stocks or junk bonds, yet they give investors the illusion of instant liquidity, the ability to buy and sell anytime. That's what creates a liquidity mismatch. In normal times, this isn't a problem. But once panic hits the market and a large number of investors rush for the exits, trying to redeem their ETFs all at once, ETF managers are forced to dump those hard-to-sell assets at any price. That's when a death spiral begins. Forced selling leads to price crashes. Crashes trigger more redemptions. Redemptions lead to even more panic selling, and eventually the whole thing can blow up into a system-wide liquidity crisis. So, as these investing masters see it, ETFs and passive investing are far from perfect answers. At their very core, they may distort capital allocation, weaken market efficiency, and even plant the seeds of a future financial crisis. Alright, now let's say you've perfectly avoided those first two traps. You've chosen the US stock market and you've picked the Standard & Poor's 500 index, the highest quality broad market index. So does that mean you can finally relax, close your eyes, buy anytime, and just make money while lying flat? If that's what you think, you're being way too naive. Because you've ignored the single most important element in Buffett's entire investment philosophy. The third and most crucial condition we'll talk about today: valuation. You've probably heard this saying: a great company doesn't always make a great stock. No matter how good the business is, if you pay too high a price, it can still turn into a disastrous investment. And that rule applies even to something as solid as the Standard & Poor's 500. The valuation level at which you buy directly determines your long-term return. If you invest regularly when valuations are too high, you might end up facing a lost decade, or even two. So how do we tell if today's market is expensive or cheap? Let's look at some hardcore valuation metrics. Valuation tool. Number 1, the Buffett indicator, market cap to GDP. In a 2001 interview with Fortune magazine, Buffett called this the single best measure of where valuations stand at any given time. The formula is simple. You divide a country's total stock market value by its GDP. What does it tell us? It shows how the total value of all listed companies compares to that country's annual economic output. Normally, the market's value should grow in line with the economy. Historically, when this ratio sits around 70% to 80%, buying stocks tends to deliver great returns. At around 100%, valuations are roughly fair. But when it approaches 200%, in Buffett's own words, you're playing with fire. So what were the numbers at past market peaks? And where are we now? Back in the 2000 dot-com bubble, when everyone was going crazy for tech stocks, the Buffett indicator shot up to a record 159.2%. Looking back, that was a huge red flag, and the market soon plunged into years of a deep bear cycle. Now, according to the latest data, the total market cap of U.S. equities stands around $69.2 trillion, while the nation's annualized GDP is about $30.2 trillion. That puts the ratio at 229%, not only well above the dot-com peak, but even higher than the 217% record set during the everything bubble of 2021. Even if we allow for globalization, which makes the metric less precise today, that number is still seriously worrying. Valuation tool number 2, price-to-book ratio, PB, and return on equity, ROE. Of course, relying on one metric alone isn't enough. So let's add another lens, the relationship between PB and ROE. PB tells you how many times over you're paying for a company's net assets. ROE tells you how efficiently that company generates profit from its equity. The key is to look at them together. If a company has a high ROE, it's a great business, so paying a higher PB or premium is justified. But if ROE is falling while PB keeps climbing, that's a dangerous sign. You're paying more and more for an asset whose quality is actually deteriorating. Now, let's compare this logic across time, the dot-com peak versus today's US market. Take the Standard & Poor's 500 as an example. Back in 2000, the PB ratio was around 5 times, and ROE was about 15% to 16%. Today, the PB ratio has climbed to 5.5 times, a new all-time high, while ROE for the index is only 18.57%. So what does that tell us? It means today's US stock market bubble is roughly on par with the one in 2000. History doesn't repeat itself exactly, but it definitely rhymes. And based on these two core valuation tools, we can draw a clear conclusion. By almost any measure, the current US market is sitting in one of the most expensive valuation zones in history, maybe the most expensive. That's not alarmism. It's a reality history has proven again and again. Let's take a look at how the US stock market has really performed, specifically the Standard & Poor's 500 index. The first example goes back to 1966 through 1982. That's a full 17 years where the index basically went nowhere. And if you factor in the high inflation of that time, the real return for investors was actually negative. In other words, after 17 years of hard investing, your purchasing power actually dropped. 17 years. Do you know what that means? That's a quarter of a lifetime for many people. After all that time, your investment account hasn't moved an inch. Could you really accept that? The second example is more recent, from 2000 to 2013. The year 2000 marked the peak of the global internet bubble. At that time, the price-to-earnings ratio of the Standard & Poor's 500 index was pushed to an insanely high level. Then the bubble burst. The Nasdaq index plunged by 80%. Just as the US market began to catch its breath, it was hit again in 2008 by the once-in-a-century global financial crisis. So what was the result? For 14 long years, the Standard & Poor's 500 index went sideways. During that time, you endured massive volatility. And after all that, your total return was worse than putting the money in a bank account. At this point, I want to ask every one of you watching, especially those in your 40s or 50s, a soul-level question. How many 14-year periods do you really have in your life to just wait and make mistakes? If you start investing at 40 and by 60 your portfolio barely grows, how would you feel? Even if the next 20 years turn into a bull market, do you still have another 20-year investing career ahead of you? We have to face the truth. Any strategy that seems to work forever will fail when valuations get too high. Ignoring valuations is not wisdom. It's intellectual laziness and a dangerous illusion about the future. Valuation is, and will always be, the most important variable in investing. Now, as we come to the end of today's topic, let's recap what kind of myth we've just challenged. Warren Buffett's 10-year bet did prove the advantage of low-cost index funds. But behind this seemingly simple, just buy and hold idea, there are 3 critical conditions you must respect. First, the location condition. The country you invest in must be a strong, growing economy with long-term upward momentum. Otherwise, you might face decades of stagnation, or even total loss. Second, the index condition. The index you invest in should be something like the Standard & Poor's 500 index, broad-based, with strong internal renewal and rebalancing power, compiled by credible institutions. At the same time, we must stay aware of the potential systemic risks within the passive investing ecosystem. Third, the timing condition. You must always consider the price and valuation when you buy in. Even the best asset becomes a disaster if you overpay. Ignoring valuation and rushing in at the peak can lock you into 10, even 20 years of low returns. Once you understand these 3 conditions, you'll realize that the so-called set-it-and-forget-it investing myth doesn't actually exist. Here's the harsh truth. There has never been, and will never be, a single investment method that everyone knows, that always works, and that makes you rich effortlessly. If such a method truly existed, it would have stopped working long ago, simply because too many people would be using it. So what should ordinary investors do? My advice is this. Instead of dreaming about finding a one-size-fits-all investment formula, focus on doing the dumbest, but actually the smartest thing. Keep learning. Learn how to read a company's financial statements. Learn how to understand an industry's business model. Learn how to value an asset properly. Only through continuous learning can you raise your investment awareness and build your own analytical framework. That's how you'll be able to see through all the beautifully packaged lies, recognize the real opportunities meant for you, and make decisions that you can truly stand behind. In investing, there's no holy grail. The only real path is to keep improving your understanding, every single day. Alright, that's all for today's video. If today's discussion gave you even a bit of insight, please give it a like, subscribe, and turn on the notification bell. I'm Caro. Thanks for watching, and I'll see you in the next one.